Hi, I'm Peter Pikalski. Our channel is devoted to business planning, financial modeling, and today, before we move to cash flow statement, we will talk about loan. How loan parameters can be inserted to financial model. Let's do it. First of all, we start a new block of inputs. Let's assign some new color. So first the block of inputs, first input will be the amount of loan, in dollars, this is the input, so we mark it with blue, like these inputs, like every input in our financial model. So let's get back to our block of inputs. Then we type term of loan, in months. We will take our loan for 60 months, for example. This is also an input. Then we specify the month when we take the loan. Year. For example, it will be April. Well, now we specify the grace period for the body of the loan payments. For example, we will have a grace period for half a year, 6 months. And also we can have some grace period for interest payments. example, 3 months grace period. Now then we calculate the months when we pay the body of the loan. We take the loan term minus grace period. So we have 54 payments of the body of the loan, and the payment will be this is if formula. Now we have to create the chronology for our loan. Now we have to put the inflow of the loan on our chronology. Look how it's done. This is if, this is and. Here we see our loan when we take it from the bank. Now we have to put one here. It is the moment when we start counting months of our loan. Now we will create the line where we count the months of loan. This is if, this is and. So here we see the months of our loan. And when we will get 60 months of loan, it will end somewhere in the future. Now we will have to put the payments of body of the loan. So here we see we have the grace period for body of the loan payments. This is grace period, and then we started payments of our loan, of body of the loan. And when the loan is over, the payments disappear. Well, and now we have to calculate the base for the debt payment. Look how it's done. So this is the base from which we pay the interest. We add the grace period here in the formula. This is if, this is and. One moment. We have to add the interest rate in our formula. We will add a line here, insert a line. Interest rate, let it be 12% interest, and let's get back to our formula here. We take the base, multiply the interest rate, fix it, divide by 12 months, so here we have 3 months grace period. And here we started interest payments. Here we see payments where and when the debt base is stable. We started payments of the body of the loan, and the payments of interest started reducing. So what we need further for the cash flow statement, we need the inflow of the loan. It is inflow, we mark it with green, and we have 2 payments. One of them is body of the loan payment. It is red because it is an expense, and interest payment, which is also an expense. So now we are ready for the cash flow statement. This will be the topic of our next video. If this video was useful for you, please like, share, subscribe our channel. Bye.